And we bring in to discuss this with me now Joe Brusuelas, chief economist at RSM. Moments ago, the first thing he flagged on his phone was this the runoff on the balance sheet, something we knew they were going to. And welcome, Joe. Thank you for being here with us on such a big day. We knew it was coming, not necessarily today, maybe in the June meeting, but this begins June 1st.
A bit of a surprise. It should support risk appetite across financial markets. I think if you've been worried about equity valuations, this is something you wanted to see, right? Second, the Fed really attempted to craft a very nuanced stance in its policy statement by saying, A, that lack of progress on inflation probably means that we're not going to get rate cuts anytime soon, and indeed most of us have pushed our rate cut forecasts back to the fall, right? I'm thinking 2 rate cuts, one in September, one in December. Now, they also did note a better balance of risk with respect to price stability and maximum sustainable employment. So the Fed's clearly signaling that they are getting movement on some parts of their mandate, but they're still concerned with the level of disinflation. Now, my sense is, and we've talked about this before, you weren't going to see the improvement in rents, in rental inflation until the middle part of the year because of that 12-month lag due to the way in which the methodology is constructed. To me, Jay Powell's confident. I think that's going to happen. So we'll see how asset prices respond here in the next hour and a half.
It's exciting when we get something to sink our teeth into. And obviously, they are not confident. They're not ready to make that cut, not going to make that move. Said it's not appropriate to reduce this rate until they feel confident, right? Until they actually really feel confident and gain greater confidence that they're getting closer to their target price or target rate of 2% inflation. The peak was over 9%. So we know things are going in the right direction, but you've had three prints, CPIs, that all show that inflation's pretty sticky.
Right, that's right. In the service sector, look, the economy is just growing at a too strong a pace. Real final private demand, first quarter of the year was 3.1%. Demand for services, and that's where inflation is the stickiest. That got overlooked on that GDP report. It was up 4%, right? So any hopes of that June rate cut basically dissipated after we saw that print. And now the Fed's having to do a little damage control, and I think it'll be pushed back into the early fall.
Last time we spoke, and I asked you about the wage number that we had seen in that last print, and you still felt that those cuts were coming. Based on your notes today, you backed off from that a little bit, right? You had a little change of heart?
Yeah, the real final private demand is just too strong. We looked at the employment cost index yesterday. It's up 4.2% on a year-ago basis. Now, a lot of that had to do with turn-of-the-year increases in minimum wage, $20 minimum wage in California. So that's going to dissipate. Now, here's the big thing, though. If you're getting productivity in the range of 2.5%, those wage numbers aren't a problem. The way you look at that is you take the inflation target at 2% and you add on the productivity trend. Well, if it's 2.5, that means we're below that. The Fed has more considerable degrees of freedom to cut than the market actually, I think, is priced in. But we'll want to watch how that goes. But hey, that's why those guys make the big bucks. They've got a difficult policy judgment in front of them based on, hey, do we think the productivity numbers are real or is it just post-pandemic noise? That's really going to be one of the key pivot points here going forward for the remainder of the year.
So there are so many things on my mind. I mean, when I think about the job market and in the Federal Open Market Committee, and the language here, job gains remain strong. Yeah, we know. I know job openings have come down, right? We saw JOLTS down to 8.5 million. That's a 3-year low. So the quit rate has sort of pulled back a little bit. I guess people have jobs, but they still want to see unemployment move up a little bit. I think that's part of it. That's going to be part of their recipe, I think, right?
When you look at quits and openings, it's back to the pre-pandemic level. And most importantly, it's decreasing in a gradual and orderly fashion.
Right.
We want to make sure that we just don't do this crazy corner solution stuff where we sing from 0 to 1 based on any data point. It's actually all moving in the right direction. This is what they want to see. We don't want to see 300,000 to 400,000 jobs created a month. You know what we really want to see? 150 to 200,000. But on Friday, I think we'll see 240,000 jobs created in the month of April. That's going to be another very strong, robust month of job increases. And that's good for the real economy. But if you're trading in markets and you want those rate cuts, that's going to be another tough pill to swallow.
How about about what's going on with rates themselves. I mean, when you saw basically the runoff on the balance sheet, that they've now announced it, 25 billion from the 60 billion that will start on June 1st. What we did see was rates came down a little bit. The 10-year yield came down a little bit. That's what we expected, and the first thing I said was this theoretically is supposed to help mortgage rates. There's no question, though, that prices, we saw Case-Shiller yesterday, and you see how prices are elevated. And when I had a great conversation yesterday, there seemed to be no reprieve for prices coming down.
If there's one area of the economy where the policy rate is too restrictive, it's housing. So we're all going to watch that. Yeah, I just looked on Friday. I saw 30-year fixed rates at 7.89%, as Jill Biden's going to get ready to come on the floor here at the New York Stock Exchange. Big day at the stock exchange, right? So yeah, the housing market is going to remain tight, but look, it doesn't matter. Demand for housing is so strong because of the demographic changes we're going through. People are going to buy houses. And look, it's really important to understand we're not going back to people getting 2 or 3% mortgage rates. That's not an artifact of history. Everyone's going to be in that 4.5% to 6% range going forward. And we'll watch that unfold.
And look, I think it's also interesting that Janet Yellen chose today to come out and say that the Federal Open Market Committee will act independently. I think she's concerned about the fall and elections and former President Trump, who could be president again. You want to give me 10 seconds on it quickly?
The Nick Tamaros article last Friday really did point out some of the risks around a new Trump presidency. If they want to take away central bank independence, the markets will go after them in a way they went after Liz Truss, the UK Prime Minister. The bond market caused the fall of the British Prime Minister.
Hold on.
Don't underestimate that.
How long was she in office?
7 weeks.
There you go. I remember that story. See?
The head of lettuce lasted longer than Liz Truss.
This is why we bring perspective. That was unbelievable. Oh my goodness. That was something. I felt badly for her. I really did. 7 weeks of a tough time she had.
It was fiscal irresponsibility what she was pushing. The bond market
Liz
was right.
Truss. I remember that so well.